Stocks falling, Trump tariffs, the Mag 7 isn't even safe anymore. What are we as investors to do? Well, if you're a long-term investor, you probably enjoy these moments. A little turbulence, although it's not all that fun in the moment, it does make for great opportunities. Did you know that over a 20 consecutive year period in the S&P 500, you will never find a combination in which the S&P 500 came out negative? 0 times. Long-term investing is a winning strategy. Investing in high-quality companies over a long period of time is a winning strategy. So as an investor, it's always so important to have a watch list of stocks. Do your due diligence ahead of time. I do countless videos here on YouTube, and I show the buy price targets that I'm aiming for. And I get comments all the time saying, Mark, you're never going to get those prices. Well, folks, here we are. And those videos weren't all that long ago. As such, in today's video, we're going to be discussing 4 stocks to buy the dip on. We've seen some tough times here in the stock market of late, but I see it as an opportunity. So before we unveil these 4 stocks, do me a huge favor, show your appreciation by clicking that like button down below, subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. This day and age, when it comes to choosing stocks, it's been a little difficult, but hopefully I'm here to help you. And in fact, the S&P 500 has been a whirlwind, and we are actually red on the year. So what are investing professionals doing? One area of focus has been on diversifying into alternative investments and real assets like blue chip art. While tariffs will have their own impact on the rebounding contemporary art market, for the past 30 years, this asset class has shown a near zero correlation to other popular asset classes like stocks. In fact, a Bank of America survey last year said that by 2026, ultra-high net worth individuals could be devoting approximately 11% of their portfolios to fine art and collectibles. Luckily, being able to diversify your own portfolios into contemporary art no longer costs billions. Masterworks art investing platform, today's sponsor, already has over $1 billion of invested capital from 65,000 plus active investors. Each of Masterworks' 23 exits has been profitable, distributing back over $60 million to investors, including principal. Keep in mind, these are investors who don't need millions or art expertise. And while I'm not an investor personally, Masterworks has over $1 billion of invested capital across 450 plus offerings from their 65,000 plus active investors. As a result, popular offerings can sell out quick, but you could get priority access by utilizing the QR code down on your screen, or you could use the link down in the description, or simply go to masterworks.art/Mark Roussin. All right, let's jump back into our video taking a look at 4 stocks to buy the dip in. Beginning with stock number 1, which is going to be the Trade Desk, stock ticker TTD. The Trade Desk is vying for those very valuable digital advertising dollars. As they work with the likes of retailers like Walmart, they work with streamers like Roku, and even insurance companies, and so much more. And the best thing about all of this, they're not really all that impacted by tariffs directly. The company currently has a market cap of $33 billion, and year-to-date alone, they are down 45%, and down 55% from their recent 52-week highs. And that high wasn't reached all that long ago, as it was back in December when they reached it. I know we're talking about buying dips in today's video, but what Trade Desk has shown is more like a slide. So what happened? Well, the company reported a mixed earnings report that missed on revenue expectations, and then they backed that up with weaker than expected guidance. However, the internals continue to be strong with the company as they have strong EBITDA margins and a strong retention rate of roughly 95%. Weak guidance has been really a trend amongst a number of different companies, because facing them right now is not only the first time that we're reporting guidance, but secondly is there's a lot of uncertainties out there in the economy. Regardless, even with all of that, I would say a 50+% sell-off is a bit overdone. And when it comes to digital advertising, this is a space that's going to only continue to grow moving forward, meaning that Trade Desk has a great opportunity in front of them. Revenues are expected to grow roughly 20% each of the next few years, which is rather healthy. Earnings, on the other hand, are expected to be slower this year, but I think they could potentially surprise to the upside, and then we see earnings growth pick back up in the years to follow. Shares right now trade at a forward PE of 37 times, which is well below their 5-year average, above 60 times. On an EV to EBITDA basis, shares are the cheapest that they have been since 2018. Even after the earnings report, analysts came out and reiterated their stance on the stock, rating it a buy with an average price target of 118, implying huge upside in the stock. Now, do I expect that? No, not in the next 12 months, but it has to give you some confidence as an investor that only one analyst rates this stock a sell, and their price target is not all that far from where we're at today. And that leads us to stock number 2, which is Novo Nordisk, stock ticker NVO. You've likely heard of Eli Lilly. Well, one of the closest competitors within the GLP-1 weight loss drugs out there is going to be Novo Nordisk. They have the offerings of Wegovy and Ozempic, two of roughly the same drugs, but they have different purposes. The company currently has a market cap of $405 billion. Year-to-date shares are up only 2%, but they are down 41% off their 52-week highs, and that high was reached back in June of last year. So here we are looking at another high-quality company that has dipped pretty well off its recent highs. Some of the headwinds for the company has been product shortages, and if you don't have supply to sell, it's going to impact your finances. Their 2 GLP-1 drugs have been going through a shortage issue. That is now finally behind it. On the flip side, though, something that's rather exciting is the fact that Novo just announced a new direct-to-consumer program as they are launching their own online pharmacy, and it will also bring down the sticker price on these GLP-1 drugs. Currently, users pay roughly $13.50 a month for a supply of Wegovy. That will drop to $4.99 per month. Still pretty steep for a weight loss drug, but to each their own. The GLP-1 race is definitely heating up. Eli Lilly is still the clear leader, but Novo is making some good headway. In terms of growth, revenues are expected to grow more than 20% this year and 17% next year. Earnings, on the other hand, will grow 26% this year and 20% next year, giving the stock a forward PE multiple of 22.8 times and a PEG ratio less than 1, which I'd love to see. Analysts have high hopes for Novo as they have an average 12-month price target of $109 per share, giving the stock nearly 25% upside from current levels. And that leads us to stock number 3, which is going to be Lockheed Martin, stock ticker LMT. Lockheed Martin is one of the largest defense contractors in the world today. And unless you've been hiding under a rock, you know about all the global tensions that have been going on. You could look at the Middle East. You could look at the Russia invasion of Ukraine. You could just see the tensions between the US, North Korea, the US, and China. There's plenty of need to go around when it comes to high-quality, high-powered military equipment. And when it comes to Lockheed, their bread and butter is going to be the F-35, one of the most advanced, if not the most advanced, fighter jet on the planet. The company currently has a market cap of $108 billion. Year-to-date, shares are down 5%, but they are down 25% from their 52-week highs that was reached back in October of 2024. Defense names have been under pressure for the most part since the new administration has taken office. Why? Because there's been a lot of focus and a lot of talk on budget cuts. And we had the defense secretary come out saying that he wants to cut defense spending by roughly 8% here moving forward. And as such, we have seen the likes of Lockheed sell off. But again, when it comes to all of this, it's talk. And regardless of which party is in power, government tends to talk a lot with very little in terms of action. So I believe that this is really overblown. And even if it does come to fruition, we've already seen a sizable sell-off. And we have a stock that's trading at now a very reasonable valuation. But let's say that the budget cuts do come to fruition. So the US is going to spend a little less than they have in years past. Now again, Lockheed has a very long backlog order. So all the orders that are putting in today, those aren't going to come to fruition for another 6 to 8 months from this standpoint. And if the US is spending less, that slack, I believe, is going to be picked up by our closest allies over in Europe. In terms of growth, earnings are expected to decline this year before picking back up in the next few years. It's a timing difference, really, but we will see if all of this comes to fruition or not. At these estimates, Lockheed shares currently trade at a forward PE multiple of just 16.9 times. That is below a market multiple by a wide margin and well below their 5-year average of 19 times. Analysts aren't buying much of the slowdown talk as they have an average 12-month price target of $5.31 on the stock, implying more than 15% higher from current levels. In addition, investors get a near 3% dividend yield in a stock that has grown its dividend for more than 20 consecutive years. And that leads us to stock number 4, which is going to be Lam Research, stock ticker LRCX. Now, when it comes to Lam Research, this is more of an AI play, which has been all the talk of the town. Everyone wanted exposure to AI over the past 2 years. Now, all of a sudden, that's gone out the window. The AI trade is certainly changing. Whether we need the high-powered chips of NVIDIA or maybe we don't need as powerful chips, the number and the pure quantity is still quite high. And there's a supply issue here in the US. So a lot of companies are continuing to build out this infrastructure. And what do they need? High-powered equipment to add to this supply chain. Who do they get it from? The likes of a Lam Research. The company currently has a market cap of $101 billion, and year-to-date, shares are up 6%, but they're down 32% from their 52-week highs that were made back in the summer of 2024. This one certainly doesn't come without risk. There's obviously AI risk. There's China risk. There's international potential tariff risk from that standpoint as well. But given the stock's huge sell-off, you have to think that a good portion of all of that has already been taken into consideration and it's already priced into the stock. I mean, look at the valuation. Shares are down 30%. AI equipment is unnecessary given the lack of capacity, which is why we see these companies continue their AI buildouts. But it's more of a cyclical business, as you can see here from the revenue estimates. Earnings growth is the same, but the company is expecting more than 20% earnings growth this year, giving the stock a forward PE of just 21 times, pretty much in line with the greater S&P 500. And the S&P 500 won't be growing earnings by 24%. So you also get a PEG ratio of about 1. Analysts rate the stock a strong buy with an average 12-month price target of $97 per share, implying nearly 30% upside from current levels. If you're like me, a long-term investor, sure, these rough periods and periods of turbulence that we go through, they're not fun in the moment, but they provide opportunities. Don't let emotions creep in. As such, in today's video, I wanted to lay out 4 ideas to potentially buy the dip in. We went into the whys, we went into the valuation at a high level, but down in the comments, you let me know which of these 4 stocks would you potentially be open to buying the dip in today. And if you haven't done so, show your appreciation by simply clicking that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.